Okay, good morning, everyone. Afternoon, if you are joining us from Toronto or some other part of the world where it's afternoon. Let's get right into it. We've got a lot to cover, and thanks for joining in. I think it's an important one, so we got lots of information to cover. Let me just go start with where we are today in the markets. We got the S&P minus 16.6. The title of the seminar or the call was stocks hit minus 20, which is technically a bear market. Now that happened intraday last week, and so we'll see what happens, but we're minus 16.6 for the year as we speak. The Dow, more blue chip oriented, is minus 12.3. Year to date, Toronto stock market at minus 4.6. Led by fantastic returns in the energy sector. We've talked about this before. Minus 4.6, so leading in terms of performance. The ETF that manages, that represents the Universal Bond Index is minus 12.2 as rates have been going up. And the NASDAQ Composite Index, which is technology-centric of stocks, is minus 26 year-to-date and hit an intraday low of minus 30 last week. So the good news is our clients are close to the flat line for the year. And so we're going to try to answer the question this time. You know, is there a reason to panic? Are we in the right spot? As you know, we killed it last year. It's nice to sort of hang on to those gains in a down market, but where are we going and should we make some changes? We're going to try to, I'm going to try to shed light on where we're going with the portfolio. So I am going to share some charts here, and there we go. Screen one. Can you guys see my screen? Okay, so we've got the 5-year bond now. I had printed this for the last call. The last call was in late March. The graph was printed on March 22nd. It was probably the 23rd I did the call. And we were at a 5-year bond of 2.24. I'm going to scroll down one more notch, and there's where we are today. So we were talking about the new environment, the new inflation, and the need to bring interest rates higher. So we have gone 2.86. So this is a really a shocking and a very, very high rate of change of the interest rates. If you look at that chart, we were below 1% a year ago and at 2.86. And again, from in 6 weeks, from 2.24 to 2.86 is the speed of which rates are going up has not been seen in 40 years. And this is creating implications throughout a lot of investors, mostly our competition, mostly other people, which is good news. But the obvious place that this is creating, because it's simply math, is the bond market. And we've talked about our exposure is zero. Most people have exposure there. You know, listen, we had to leave a bank because you are forced into an asset allocation of 60-40. If you're a modest risk, they make you buy 40% of bonds. So the single biggest mutual fund is the fourth biggest in all of Canada. The single biggest mutual fund at the entire bank of TD Bank is the TD Bond Fund, which is minus 11.5%. And I'll just reiterate that it's math. If you bought a bond at 1% for 10 years and today rates are 2.85 and you have 9 years left on your bond, no one's going to buy it from you with a 1% yield. You're going to have to sell it to them and say 85 cents on the dollar, 87 cents on the dollar, so that they're getting the yield to maturity, including their capital appreciation of the prevailing rates, which is pretty close to it's a 3% handle on a 10-year government bond today. So the other place that people are feeling it is in balance funds. And again, the RBC Balance Fund, which is the single biggest fund in Canada, something in the neighborhood of $80 billion. People are feeling it, and it's minus 12.2. And even though the Toronto Stock Exchange is minus 4 for the year, that's Canadian focused, it is unfortunately has technology exposure. And of course, it's 40% bonds, which are dropping in value. So enough on that. You have no exposure to the bond market, people. So I'm just kind of bashing my competitors here a little bit. So let me go down. The other place we talked about in the end of the year last year, and in fact, we talked about it last fall, and I did a chart of Tesla versus many other really solid businesses where you could collect dividends and the valuations. The ARC Innovation Fund was a fund that was red hot. It was growing. I think in 2020, in the pandemic year, it was up some staggering amount. And this became the poster child of what they call new innovative companies. So a lot of brand new companies. Tesla's their largest holding, but a lot of crypto currencies and things like that are businesses that were involved in crypto. Year to date, minus 55.1%. Of course, my clients will be happy to know that we have no exposure to this sector of the market, which, again, has been good. So where are we on the technology? Because as we talked about, interest rates going up has not been good for technology shares. So this is a chart of the NASDAQ index, which is again dominated by companies like Apple and Tesla and Google and Amazon. And I want to point out the index. This is a logarithmic index. So if you notice on the left-hand side of the screen, you'll see the distance between 1 and 2,000 is the difference between 2 and 4. In other words, these moves are all percentage. So if you look at a line on the graph, the moves are same on size as they were, even though the index was much smaller. So I want to point out that the move down is not nearly anywhere close to the move down is the last time the tech stocks went down. Now, I've said a number of times that there was a lot of similarities between this market and the market of 1999-2000 top. There's a lot of similarities, but there are a few differences. And in my opinion, I've said that the tech bubble wasn't as great. There was bubbles in many sectors, but the big large cap Apple and Google are not as overpriced in terms of price earnings ratio as they were back then. But I just want to give you scope of magnitude and just point out that we do have further downside to go in the bubble areas of the market, which are overowned and over still overvalued in terms of valuations. So it's interesting. I'm going to show you something that goes back to our banking days, and we have a graph of risk reward. And I'm going to go back up here. I want to point out that the NASDAQ took 18 years to get your money back, which is a hell of a long time to get your money back. Now, the S&P 500 is still, technology is the biggest sector of the S&P 500. And so if we look back, the S&P 500, we've got returns on this side and we've got risk as measured by volatility. And I've got the TSX, which did 4.4. The S&P 500 did only 2.5. And this goes from 1999, just before the bubble peak, until 2016 when we left the bank. And then we have LePoidevin Group net of fees. Now, I will just caution, the S&P, that's just the pure index. So if you add 2 more points to for dividends, because mine include the dividends and net of fees. So I just want to point out that our clients, you know, did very, very well, despite the fact that many investors took a long, long time. So the S&P probably did closer to 4.5 over that time, but we did double the return, more than double the return, with substantially less risk than the markets in terms of the S&P 500. Listen, we were trounced by the S&P in 2019 and 2020. Thanks for sticking with us. I think we have a group of clients that don't like that kind of risk. And let's remember that 99 and 2000, there's an entire generation, unless you're kind of over 45, you didn't lose any money in the last time that this happened. So there's an entire generation of investors that you know, thought that this was a panacea to wealth. I'm going to go back to that slide in a minute as we try to answer the question of, you know, what's happening today. The next area that we said would be affected by rising rates is real estate, and we thought that Canada was particularly vulnerable given the fact that there was such a high percentage of floating rate mortgages. And the title from this Reuters News headline is Canadian home prices slide 6.3% in April from March. And remember, this is only the beginning. So the Bank of Canada last meeting raised 0.5%. And there is a 99.99% chance that they're going to raise again on June 1st, which is not very far away. So if we're already weak, we're going to get weaker. Now, I will caution that this is median selling price. And so median selling price can be skewed by the amount of high-end homes or the percentage of low-end homes. But the direction of the market has turned, and it's turned very, very quickly, because we were red hot in January and February, but rates had not started going up yet. And we talked about this at length. I did, you know, go back to my previous, if you got a moment, go back to our previous conference call or Zoom video. It's on YouTube. You can see how the numbers when rates are going up affect the market. Let's also remember that to start the year, a 5-year mortgage at RBC had risen, but it was still sitting at 2.19%, and they are at 4.39. So we have doubled. TD yesterday went to 4.59. It's been 40 years since we've seen interest rates double. You could still say rates are low, but it's the magnitude. You know, it took 20% of interest rates in 1981 to crush the market, but mortgages were kind of 100,000. Now we got people, young people with $1 million mortgages, you know, and as mortgage rates approach 5, you're paying $50,000 a year, up from 20 just on the interest portion of the mortgage. So this is a material change which is going to affect the demand side. So on interest rates, where are we? Where are we going? Just to put it in perspective, this is the U.S. Fed funds, and U.S. Fed funds are still only at 1%. Bond yields have risen in anticipation. As I showed you the chart, we're at 285. But where are rates going? They're going higher. Now, the question that we have, are we going up to the levels of back here? Are we going to this level, to say 99 levels? Are we going, you know, back here? Where are we going? The answer is, because this may be the key to the puzzle of you know, where stock valuations and where we're going. So I'm going to go on here. This is a very, very important chart, because man, the internet's amazing what you can pull up. But going back, and we've talked about in the past calls, and for you, people that are new to the call, I've likened the pandemic to a world war. It's the closest thing, and as people know, we are students of financial history. And why I liken to the war is we spent in deficit spending as much as World War II on a inflation per capita basis. And think about the troops coming home after World War II. And General Motors was no longer making cars, they were making tanks. The war ends and you got to switch back to cars. So there was all kinds of supply shortages. And we've got the double whammy today of supply shortages from the pandemic, where there was manufacturing shutdown. We have a chip shortage, and we have the war in Ukraine, which is sending fertilizer prices up and agriculture prices up. But I want to point back to 1946, because this dot here, what we have is the red line is the inflation rate, spiking like we haven't seen since back here in 81. We've got the interest rate in the black line, and we've got the blue line being the real rate. Now, real rate matters because it is the interest rate adjusted for inflation. Now, it's very interesting to see that the only other time we saw a real negative spike in real rates was back in 1946, when there were supply chain shortages. But notice here that interest rates did not spike like they did in 1981 or even 1991. They actually stayed fairly well contained, and they let real rates. Now, there was a recession here in 1949, not 1946, where inflation was spiking, 49. One of the conditions that you need to hit recession, clients know from the LePoidevin Group that we don't fight the Fed. That's the number one rule. The US Fed sets US interest rates. They set the tone for the world. So the question is, are interest rates high? Are the brakes on? Are we going into recession? Now, every recession in US history is preceded by rising rates. But if we look carefully, let's look at the economic recession of 2001. You can see that prior to that, we had quite a while of real rates being positive. You can see the 81 recession. One of the things you need to enter recession is you need rates having gone into a real return basis. So in other words, if inflation is high, is there going to be the attraction to move to cash? So Bank of Canada is going to hike. And this is the $1 million question. I watched this morning, I was driving to work and with my son, Alex, who is working at Canaccord for his summer job, not for LePoidevin Group, unfortunately, but doing some other things. And we were listening to Charles Fisher, who is one of the voting members of the Federal Reserve Board. So here we have some inside information. And they talked about the need to get quickly back to neutral. And his definition of neutral interest rates was 2.25 to 2.5. So if T-bills and cash are going to 2.5, is that going to entice our clients to say, we're out, get out of stocks. I don't want to earn my dividends on, TELUS or Verizon. I want out, I want in cash. And then, so the question is at 2.5. Well, then you're still deeply into negative real rates. So this is an interesting conundrum. Now, again, is this 1981 or is it 1946? There is a very important difference, and as you know, we predicted this spike in inflation. We looked at the money supply. We looked at that it was annualizing at close to 40%, which was unbelievable. We said too much money is going to create inflation, supply chain shortage enough. I can tell you that the annualized rate in the money supply for 2022 is down to 4%, below trend. So is there a transitory element? And the answer is yes. And this inflation number is going to stay high. Bank of Canada, just rates ticked up to 6.7. inflation rate today from just up 0.1. Inflation is going to stay high, but are we going to see it persist and go higher and higher and higher, or is the price of beef a one-time spike? Is the price of energy going to keep doubling, or is it going to stay contained? This is a chart of the 10-year, and clients will know because we've invested in these, treasury inflation bonds versus nominal bonds. So there's a bond out there you could buy that's 10 years that you could get the inflation rate plus or minus a fixed rate, or you could just buy a fixed rate bond. So if we take the nominal bond versus the inflation bond, we know what the inflation expectation is. And you can see here in the pandemic, people thought, oh my God, interest rate inflation is going to be this is terrible. This is like deflationary. Inflation expectations went down to 0.5. Well, we did call saying that was ridiculous because they're printing money. We're going to have inflation again. This number has been kind of anchored around 2. It spiked up to 3% inflation expectation, but you can see the numbers come down to a 2.6 inflation expectation. One of the main differences, and I'm not sure this is sustainable, but we will see. So one of the important differences between the 80s, the 70s, late 70s and the 80s is inflation was ingrained in society. And I'm not picking on any union, but if the teachers are going to strike and say, well, inflation is 10, we need 10 plus 2, for example, we need 10 as part of our next 5-year contract because that's what it is. And we are not seeing that expectation being embedded. These inflation break-evens are not sitting at 10, they're sitting at 2.6, which is elevated from where it's been. So the question is, how high are rates going to go? And there is hope that interest rates, the US Fed, again, we heard it from Charles Fisher, they want to get to neutral, and then they're probably going to pause on interest rates and see what happens. And that's kind of around the 2.5% range. So going back to this chart, don't fight the Fed. Are there opportunities? This is a stock market that a month ago we were, I would say, we weren't just holding our own for the year. We were up nicely for the year. Now we've dropped to hold our own. So what's happening? Well, the massive sell-off in technology, this ARK Innovation Fund. And I hate to say, we're not in this asset class, but there's a lot of investors in cryptocurrencies. 2 things are collapsing at the same time, which is ridiculously overpriced tech stocks and cryptocurrencies were collapsing at the same time. And sometimes we get, when the margin clerks are in charge, margin is you're borrowing to buy, and you own crypto and you own tech stocks. What do you sell? Well, you sell what you can, not necessarily what you ought to sell. And it's human nature, but people sell their winners. And so if you look at, say, a preferred stock or an energy stock, this is what the inclination is. I want to sell what's up. Don't sell my losers, sell my winners. And so there was a little, we finally seen for the first time this year that sort of capitulation, and it was being driven by stuff that we don't own, and it touched our stuff. Am I worried about our stuff? I really am not. Are we going to enter a recession in 2022? We are not going to, I will say in this call, we are not going to hit a nominal recession. Now, again, there's a difference. Recessions are defined by a decline in real GDP. So that's GDP less inflation. So if inflation is running at 6 or 8%, if the economy doesn't grow at 8, you're technically in a recession, because the economy, if it grows at 6 and you've got 8% technical inflation, you're technically at a -2. But that being said, earnings are growing. The economy is growing on a nominal basis. And so while inflation is going to be eroding wealth, and I've been political, I am not a fan of inflation. I don't like politics that leads to inflation. I don't believe we should be infrastructure spending, which is going to compound inflation. I don't believe that they should have sent out as many checks. I believe they did the right thing during the pandemic. They sent out too much free money. I'm not a believer in inflation, but that being said, this is not politics. It is what it is. So the answer is there's no recession. We're not going to see a hard GDP is lower. It may be on an inflation adjusted basis. And that means our best chance of beating this inflation rate and making sure our money grows is by investing and owning good companies, because there are so many bargains. I'm going to go through a couple of things here. So there's the break even. I want to show you a chart of something that I've been talking about for a couple of years, and it's truly exciting. This is a chart of Enbridge Preferred U. Now, we had about $9 million on the books, and this particular preferred, this US dollar, this particular preferred, now the preferreds that we like, and I'm going to backtrack for one moment here, because I think that I have been in the business 37 years, 3 absolutely exceptional opportunities in fixed income. And the first one, when I was a young guy, and unfortunately I didn't have a very big client base, but I still have many of these clients. Anyone that would listen, I said, you ought to be buying 10 or 20-year bonds at 11%. Now we chuckle now, and it was a tough sell because people say, oh, I can get a 1-year GIC at 12. But that was an exceptional opportunity in hindsight. That was fantastic. Not only did we make our 11, but the bond soared in value. So we got the 11 and we got appreciation on top of that. So it was a double win. The next piece of exceptional opportunity happened in the late 90s and early 2000s. And that was, and many of you have been with me long enough to remember the real return bonds, which were offered at 4.25 plus inflation. 4.25 plus inflation. Literally, you didn't need to own a stock no matter what happened, what the outcome was. The government of Canada was going to make sure that your wealth was increasing at 4.25, which was historically an unbelievable opportunity. Now, this is one of the reasons that we outperformed the S&P by such a dramatic amount for that period after the blow up of the last tech bubble, is because we had an exceptionally high portion of this bond and fixed income opportunity. We are on right now the 3rd greatest opportunity in fixed income. Now, this is very exciting because we need places to make money, and we need places to make money. Our money's losing, cash is losing. What are we going to do? Now, this is one of our US dollar preferred stocks, and good news and bad news. Okay, the bad news is they've taken our preferred that we bought at 19, 20, 21. You can see it was trading at 22.40 a couple of weeks ago, and unfortunately or fortunately, they said, you know what? We're done. Every 5 years they have a window, and that window is we can pay you back our $25 par value. So they came along and said, we're done. We don't want to pay you. And the reason they did that is every 5 years as well, they have to readjust the dividend. And that dividend was preset by the terms of the debt offering. That was set at 3.05 plus the 5-year government bond. So the dividend was $1.22. Now we're very happy just sitting on this preferred. But the new dividend was going to be set at $1.51. And that was going to be north of 6%. So Enbridge just topped out. They just said, you know what? We are paying you back your 25. Now for us, We didn't buy it at 25. We bought a deep discount. If you owned this, from when it was a new issue at 15 years ago, you got your money back. If you're our clients and you bought it at $20 or $21, it's a home run because you collected a great dividend along the way. It's also interesting. Now, we didn't own this because it wasn't at a great enough discount, but Industrial Alliance yesterday announced that they're going to call one of their preferreds, $250 million issue. They're going to call theirs. This is going to be a growing theme. Remember, I was showing you that chart of rates. Rates are higher. So remember this chart here? Rates are going up. So think about these preferreds were resetting at 1 plus the agreed on reset. Now we're up here. So these companies have a very, very difficult decision to make on whether they're going to pay us a lot more dividend or whether they're going to call them in. Now, here's another one that didn't get called. Mixed blessing. The dividend was 85 cents. This is Enbridge B, and it applies to the Enbridge Bs and the Cs. The dividend was 85 cents. The deal on this one was 2.4 plus the 5-year Canada. So now their dividend is going to be $1.30. Now at par, they have to give us 25, not market value. So they have to give us 25. So at 25, they would have to pay us 5.4%. Okay, I know this is complicated stuff, but if you get a little bit of it, you're doing well. But you can, these are the facts. The old dividend was 85 cents, so it was 4-point-something%. Rates 5 years ago were a lot lower. This is pre-pandemic. Rates were a lot lower 5 years ago. They're a lot higher today. So the new dividend is $1.30. They didn't call it because they said, you know what, we'll just pay you the 5.4. But look, it's trading at 19.5. That's 6.8. Now they just called something at 6. We're collecting 6.8. You can see the share spiking here, but mixed blessing. I'm happy to collect 6.8%. In the next 5 years, we give it 1.3 times 5. I'm going to collect 650 of dividends. And probably in 5 years, they're going to have this very difficult decision to make again, probably going to pay us 25. Unbelievable. This is just one example. Fairfax, Bell Canada, all of these. We have a huge amount of Bell Canada Bs. They're going to be reset in September, and that dividend is going to go up dramatically. The Fairfaxes, listen, we're into phase 3 of fixed income, a tremendous opportunity. And in the last couple of weeks, we have seen some weakness only because people are losing their shirts in their tech stocks. Send money in. Don't call me and say, I want to raise cash. Send money in because this opportunity will not be around. They'll get called one by one by one. Let's remember, as the Enbridge U that we had, we've sold it, by the way. We're not waiting because we sold it at the par value. We're not waiting till we get our money in a few weeks. We've already bought. We just took that money and bought stuff that we think is going to get called in 2 years because they have an anniversary rate in 2 years, and we're buying those at $18 and $19. Let's talk about the S&P. An interesting thing just happened on the way to the supermarket. An interesting thing just happened. This is a chart of the S&P 500, price of the S&P on the left-hand side versus the earnings of the market. Now, you can see here, 2012, we're exiting the last great recession. Stocks are undervalued. You can see the overvaluation going into the pandemic. Things are good. There's nothing wrong. Overvaluation. Earnings collapse in the pandemic. We go from overvalued to undervalued. As you know, we bought a lot of stocks in the pandemic lows, or we didn't sell anything because that was silly. You can see the tech bubble here is driving the market way above the blue line. You can see here that, one of the things we talked about in our calls of last fall, December, January, we've been consistent. There was a bubble in tech. There wasn't a bubble in tech resources, not technology. There wasn't a bubble in energy stocks. There wasn't a bubble in good old industrials, in life insurance companies. So the interesting thing is with this 30% decline in the NASDAQ, with the 55% decline in the innovative stocks, we've touched that line. So this is kind of good news. The valuation, the market has declined to a price earnings of about 17.7. Interest rates are still lower than bonds are not representing value relative to the stock market. So that perspective, the stock market, in terms of valuation, is looking like it's actually on its close to average return. Look, are earnings going to go up? Yes, they are. Are they going to go up as fast as that line? This is not a logarithmic line, so it looks like, oh, earnings are barely growing here. The index is more than doubled, so you've got to sort of skew that out. Earnings are not going to grow as fast. They're going to grow a lot slower, and the reason is because inflation affects businesses too. If we look at both Target and Walmart, down substantially this week because their costs are going up faster than they can raise their prices to consumers. So you're going to see some effects of, but is Walmart going to continue to raise their prices? Yes. Is Target going to continue to raise their prices? Yes, there's a lag, and they eat the lag. But almost our best chance of making a return is to own businesses. And we're not in recession camp. We said we were on recession watch last time. And again, there could be a technical recession, but not a nominal. We're not going to see earnings decline. We're not going to see the thing fall apart because you have to, there was a series of recessions in the 70s, but that we never saw until 1981 an actual, a hard actual decline. We only saw a technical recession. So, stocks were the place to be as we lost our money to inflation. Is inflation going to stay high? Yes, it is. There's technical reasons why. Shelter costs, for example, there's a lag. They're still going higher, and that's the biggest component of the consumer price index. But is the Fed going to raise rates to, say, 8% or 10%? Not imminently. And so if we kind of pause out at a neutral 2.5% rate, we'll muddle through, we'll collect dividends. I said at the beginning of the year that this would be a challenging year. And I said we didn't want to own tech, and we didn't. So as a result, there was too much tech in the S&P 500. So we didn't want to own the S&P. Would be a very challenging year. Second year of presidential cycles are the most challenging. And we've got some questions about that Marc's going to answer. But I'm still going to hold to my single-digit most likely outcome for the year. It's the second year of a presidential cycle. It's the toughest. What do? We collect dividends. We're going to make money in preferred stock. We're going to make money in many businesses are grossly undervalued, and those are the ones that this is why we're not losing this year. So that's kind of it. Here's our disclaimer. So all of this is taken with a grain of salt. But look, very interesting discussions. I'm glad we're holding up. We've had a lot of calls from people who are looking at the headlines but haven't looked online or haven't seen a statement if you're not online. And the market's getting crushed. And I say, oh, Mr. Client or Mrs. Client, you're not down, or you're down 1% or 2%, and it's a relief to them. So if you're listening to this call and you haven't looked on your statement, we're doing fine. So that kind of that concludes. And I apologize. I've gone over. That's a lot of information, but important information of where we're going to make money for the next 6 to 12 months. And I'm sure we'll be tuning in again shortly. Marc, you've got we had a number of questions, a lot on the same topic, so I'm going to pass it over to Marc.
We got we've got a few different themes of questions, but they all kind of center around a few of the same things. So I know Dave went into overtime here, so I'll keep it kind of brief. Second year of presidential cycle and midterm elections. We got some questions on that. We've addressed that last year about heading into second year of presidential cycle being more challenging. Here we are, and now we've got the midterm election questions. So found this interesting chart, just looking at the trend of your non-midterm election years versus your midterm election years. And yes, this is the weakest start since World War II of a midterm election year. Some of the actions of the Fed and Russia, Ukraine likely exacerbating that. But generally speaking, we're following some of that typical midterm election trend.
Just to be clear, Mark, this is an overlay of every midterm election since 1950. So if we say, so just to be clear on that.
Yes.
So the blue line and the white line is every other year, including non-midterm years. So that's right. 3 of 4.
Yeah. So just to, sort of, continue on that thought, the average annual return of the S&P 500 in 12 months before a midterm election is 0.3%, which is significantly lower than your historical average of 8.1. The S&P 500 has historically outperformed the market in the 12-month period after a midterm election with an average return of 16.3. So the point of this is to just say we're kind of following the trend line from a historical perspective. Again, certain things are exacerbating that, I think, in the near term, but it's interesting to just keep an eye on it and watch that trend as we sort of move forward. Next area to talk about is gold. Got a lot of questions around gold in different ways, but generally just, where are we at in terms of our thinking around gold? So I also included, I'm going to flip to this one quickly. Here's your sort of year-to-date gold chart. And here's a year-to-date of the US dollar index. Now, the US dollar index is an index that measures US dollar performance versus a basket of currencies, including the euro, the yen, pound, Canadian dollar, Swedish krona, Swiss franc. Okay. So you can see we've had a lot of inflows into the US dollar relative to other currencies. That's typical of a year where you've got a lot of volatility, a lot of market weakness. US dollar as a safe haven gets a lot of flows, and typically gold's performance is going to be negatively correlated to US dollar strength. So just to see that sort of tie in. But when we dig a little deeper, found this chart, which I thought was really interesting, which looks at gold versus real yields. Okay. And this period of the 70s specifically is really interesting. So we had high nominal interest rates. That's interest rates without considering inflation. We also had inflation, which was high and higher than that nominal interest rate, which created a negative real yield environment. And as you can see, we had a really strong performance for gold. As soon as Paul Volcker stepped in and really kicked off interest rates, where we all of a sudden interest rates exceeded that of inflation, we entered this period of weakness for gold. Now, looking at where we are today, we've got some pretty good conditions in place for the price of gold from our perspective. Okay. You got very low nominal interest rates and very high inflation. Okay. So the conditions to us look really good. And if we look at the price of gold again, in terms of this year, it kind of played out to form early in the year. Very low nominal interest rates. The Fed hadn't started to move. Bank of Canada hadn't started, but you had inflation starting to move higher. You had some capitulation from the Fed around the term transitory. And so gold sort of did its thing. We had this outperformance period, likely a result of Russia and Ukraine. And then we've come off. And this is likely a result of a few things. We've kind of entered this indiscriminate selling period. Gold, as David touched on, has kind of been touched by that, a result of, tech and other things rolling over. And you've had the Fed getting more hawkish. Real rate expectations have sort of come up. But going back to this slide, I think this is really interesting to look at how the effect of negative real yields, which is the environment we're in, has typically been really conducive for the price of gold. And so that's why we continue to think it's a good place to be for a portion of our portfolios. And the last thing I'll touch on is quickly is Canadian dollar versus US dollar. We talked about on some of our previous calls when the Canadian dollar was in and around 80 cents, that was sort of home base. That was fair value in and around the purchasing price parity. Today, we're sort of in around 77 and change. So if we see some market strength, it makes sense to us that we could see some Canadian dollar strength back up closer to that purchasing price parity level. Longer term, I know David and I have some of our concerns if Canadian credit were to really crack, but in the short term, we're sort of looking at any sort of market strength kicks us back into that purchasing price parity level of in and around 80 cents. Okay, that's it for me.
Awesome, guys. Let me know what you think of the call, and stay tuned. We will keep you updated, of course, as conditions change. And but we're here to keep to be proactive in this market, and lots of opportunities. Thanks again, everyone.